So this was a question in May 2015. Question number 1B. May 2015, question number 1B. The question says that Chuma Limited is considering replacing a machine. The existing machine was bought 3 years ago at a price of 50 million. They want to replace a machine. So this is a question about replacement. Remember, we are doing revision. And the question is from topic number 1, which is advanced capital budgeting. So we're talking about replacing a machine. You remember the subtopic of replacement analysis. The machine itself was bought 3 years ago and at 50 million. The machine is expected to have a useful life of 5 years, 5 more years with no scrap value at the end of its useful life. So that means that the machine should have gotten or should have had how many years in total? We want to replace a machine that was bought 3 years ago. The machine is expected to live for another 5 years from now. So what is the total number of years we expected the machine to live?
8 years.
Thank you so much. So the old machine right now, after 3 years, is to be replaced. Another information that we know is that we can remember the initial value or initial outlay of the machine or cost of all machine, which is 50 million. Expected useful life of the machine is 8 years. We are on old machine. So this therefore means that we can calculate the depreciation of the old machine. Which should be 50 all over 8. The machine was bought at 50 million and it was supposed to stay or live for 8 years. So that means we are expecting to have a depreciation there, which you can calculate. Let me mute them. Let me see if there is a scrap value. So the machine is expected to have a useful life of 5 years more with no scrap value at the end. So there was no expected scrap value. What is the expected depreciation here? Of the old machine? How much? Depreciation for old machine? Is it 6250? 6,250. That is the depreciation if it was supposed to stay for 8 years. By the time we are now selling the machine or we want to replace the machine after 3 years, want to replace it after 3 years, how much has actually depreciated? So we can be able to get our net book value of the machine at the time of replacement. Net book value at the time of replacement. That is, what is the net book value? We take 50 minus depreciation for 3 years, which is 250 per year times 3 years. So what is the net book value? The written down value after 3 years. Ile value imebaki. It is depreciating up to 6,250 per year for 3 years. So what is the net book value? So the machine should have remained with this value. But we are now replacing it by selling it at a certain price. We are told that the machine could be disposed of immediately at 35 million. So instead of us selling it at the net book value, we are disposing at 35 million. Are we moving together? Instead of it being sold at the net book value, we are selling it at 35 million. So are we making a profit or not loss? We are making a profit. Are we together? So if you are making a profit, there is something we call the tax on disposal. Tax on gain on disposal. When you make a profit, you pay tax. Whenever you sell something which is a capital asset, whether like a building or land, and you have gained something, there is tax on capital gain. What we normally call CGT, right? Capital gain tax. Immediately when you sell a property, you pay CGT, capital gain tax. So this one is going to be paid because we are replacing the machine. We are going to sell it and then we buy a new one. So there's money that we're going to pay here. Are we together? From our bank, the income that we're going to get, we are going to pay some money. So we have capital gain tax, which is now the difference between this and this. That is 35 million minus what should have been realized. Is it 35 or 350? Let me see. The correct amount is 35 million. 35 million is the market value. So that is 35 million. This one is in thousand. So we have 35,000 minus that times 30%. How much is the CGT, the capital gain tax? This is what should have been the net book value, but we sold it at 35, which is the market value. We gained something. Whatever we have gained, there is a tax there. So it is 1,1,250. That is the capital gain tax that we're going to pay because we are selling the machine. So from this information, you can be able to see that the first paragraph, we are able to condense it or bring out the information and have it on the board as follows. We can proceed. The new machine will cost, now we are replacing the machine, remember? We have said that we bought it. We are selling it at 35, but we're going to pay 1,125. That is money that is going out because we are selling the machine. Now, we are saying that the new machine will cost us 80 million with a useful life of 5 years. At the time when we are deciding on whether to replace the machine, it was supposed to have 8 years. It had only taken 3 years, meaning that we still had 5 years to go with this machine. Probably our project was for 5 years. Our project was supposed to take 5 years again, or 5 years more. The initial one was 8 years. We have done the project for 3 years. We still have 5 years to go. So the machine that we're going to buy, the new machine, should enable us proceed and complete the remaining period, which is 5 years. And that is why they are saying the new machine will cost 80 million with a useful life of 5 years. Itatusaidia tumalize the remaining period, 5 years. And an expected terminal value of 5 million. That is the final value at the end of 5 years for this new machine. The introduction of new machine, with introduction of new machine, the sales are expected to increase by 25 million. So I am hoping that you have written this. We can now start working on the new machine. You have this information, right? Let's now start working on the new machine. New machine. So the new machine, the value, or we call the cost of machine. The cost of machine is how much? 80 million. Which we can have in thousands. So we can have our figures in thousands. The machine will cost us 80 million to buy. Then we are told that with the introduction of the new machine, the sales are expected to increase by 25 million per annum over the next 5 years. That is the total revenue. Every year, the contribution margin is expected to be 40%. Do we know contribution margin? That percentage of contribution margin is helping us to do what? What does it help us to do? How does it help us? Contribution margin, the percentage of contribution margin inatusaidia kufanya nini? To get the variable cost, percentage of sales. So it is a percentage of sales. Contribution margin is a percentage of sales, which can help us to get the variable cost. So variable cost is the remaining 40, the remaining 60 still. So for those who don't understand, normally when we have sales, contribution margin is just sales minus variable. Contribution is sales minus variable cost. This is the contribution. Contribution margin is a percentage of that, because when you have this, it is the variable cost and contribution, which is just the profit immediately, the gross profit immediately after sales, that is equivalent to this. These two should sum up to this. So that means that if you are having 50,000 here, and this one is 25, tumetoa, tunabaki na 25, it is clear that 25 plus 25 is 50. So here is 100%. This one is 50%. This 50%. So it means that the cost is 50% and the profit, just the immediate profit after the variable cost, which we call contribution margin, is 50%. That therefore means that if you are doing accounting, then you can simply get the contribution margin, which is now 20 or 50%. Then you now less fixed cost is if you have, and proceed. Either you can come back and start doing this, you will still get the same answer, or just get the contribution margin. Whatever you get here, proceed and minus the fixed cost. I hope that we are together. So we are told that we have a contribution margin, which is 40%. So 40% of 25 million will be our profit. We simply deduct fixed cost from that. We are saying that the operation of the new machine will also require an immediate investment of 80 million in working capital. You know working capital, where will it appear? There are two areas where working capital will appear. The working capital normally appear in two areas. Where and where? Where do we find the working capital? Initial cost, where else? The terminal value. Thank you so much. So we'll see working capital in two ways. Working capital is not the cost of the machine. It is the amount that you have to pump in so that you can start operating. Sasa ni kama cash in the bank that you'll have to pump in and then you start operation. Now, we are saying that it is 8 million. The initial cost of machine will amount to 6 million. The installation cost of machine will amount to 6 million. Where do we put the 6 million? That installation cost, where does it belong? Where does it belong? That 6 million, which we are told installation cost of new machine will amount to 6 million. Hiyo tunaweka wapi? Where do we put the 6 million? You guys can talk. Where do we put the 6 million? Somebody can tell me. $6 million. Tunaweka wapi? Oh, did I mute everyone? Okay, you can chat me. Normally, the cost of machine include the cost of purchase plus installation cost. That gives you the total cost of machine. Sasa, total cost of machine is the cost of buying the machine and the cost of installing it. Sasa, so installation cost here we have. So this is the cost that you need to depreciate if you want to depreciate anything. Sasa, so our total cost of the machine is now 86. So now we are being told that we bought this machine at now 86 million. That is the total cost, which we shall depreciate if we will have to. But then we were buying it at the time when we were also selling the old one. So inamaanisha, unauza ile ya kitambo at 35 million, tumeambiwa hivyo, and then you buy a new one to replace it. So how much did you put from your pocket, the outlay? Pesa ngapi ilitoka kwa mfuko? We want to look for the initial outlay. Ni pesa ngapi tulispend kwa hii new machine? Angalia chats. Naangalia chats sioni, or did you send some? we have 59. Thank you. So you're saying that we have spent 59, right? Huh? 86 minus 35, 59, right? Okay, oh, 51. So we are saying we want to get the initial outlay, so you less the market value of the old machine. Ndio tujue ni pesa ngapi sasa tulitoa kwa mfuko kwa ajili ya hii machine mpya. So less market value of all machine, which is now 35. So you're going to have here 51 million, which we write as 51,000. That is the amount that you're releasing for the purpose of buying the machine. Maybe it's Jayona. There's another one that you've sent. Add cost of machine. Okay. Now, this is the amount that you've given out to buy the machine, but it's not the only cost. We are now determining the initial outlay. Now you come and say, determination of initial outlay. So you start with the net cost of buying the machine, net cost of new machine, which is now 51 million. We also have tax that we pay. You bought the machine and you pay tax because uliuza ile ingine. Kwa hivyo kuna pesa ulilipa kama tax. Ni ukweli? So you add tax, add capital gain tax, that you also pay, which you are calculated. What else did you pay for? We also have initial or working capital. See, add working capital. These are the real money that left your wallet. So how much is the initial outlay? How much is the initial amount that left your wallet? The initial outlay. $60,125. Are we okay there? Is there any person with a challenge how to work out the initial outlay whenever we have replacement? Kuna mtu akona shida? Kuna mtu akona shida? Okay, so hiyo tumemaliza. So uko na IO, what we call IO in the new machine. The next thing now is to calculate, because we want to tell the management whether to replace or not. And the only way we can tell them is when we are able to calculate our NPV and know whether it is going to give us a loss, the new machine will give us a loss or profit. Tunaelewana? We are told to advise the management. We need to advise the management on whether to replace the machine or not. So we want to ask ourselves, the new machine, is it going to give us a positive NPV or negative? If it is positive, then we can proceed and replace. So our main aim is to get the NPV. And in NPV, you need to know IO, you need to know the PV or PV, then you need to know the cash flow. Now we have our IO. The next thing that we now need to look at is the cash flow. How do we get the cash flow? We have the information, right? So you say cash flow statement. Cash flow statement. Cash flow statement. So the cash flow statement, we are told that the sales that we are making yearly, or we call it annual sales, is 25 million. And we are told that contribution is now 40%, which is 19 times 25 million. So what is our contribution? What is our contribution? Which is the immediate profit after taking the sales minus variable cost. That is the contribution. So what is it? We are assuming variable cost iko mahali hapa. So ukitoa unapata hii contribution. What is it? What is the contribution? That ka profit before 10,000. Tunaelewana? So you're going to have 10. Hata hii weka tu hivi. So you're going to have our 10,000. Now the next thing is to less fixed cost. Do we have fixed cost? Are we given fixed cost anywhere? We don't have. So we are having dash, right? So if there is no fixed cost, then it means that now we can have 10,000 as our profit before depreciation and tax. Profits before depreciation and tax. Now, up to this stage, there are two things that you can do. Number one, you can less depreciation from here and tax the balance. Then you add back depreciation. That is what we normally do. What you do from here, you can always deduct depreciation, tax what you're going to have, and then add back depreciation. That is the first thing that we can do, which you know. Another way is to just tax this amount. After taxing it, you add depreciation tax schedule. So you can go ahead and tax this, then you add depreciation tax schedule. How did we get 10,000 as profit? Contribution margin, we are given 40% of 25. 40% of 25 is 10. Kindly confirm. Confirm if it is true. So I'm saying that there are two options. You can either minus depreciation first, then you tax the balance, then you add back depreciation. or you tax it direct and now add depreciation tax shield. So you can have now tax at 30% will be 3,000, which you're going to deduct. So you remain with 7,000. You simply, that is now profit after tax. Then now add depreciation tax shield, which is 30% of depreciation. So what is the depreciation? 30% of depreciation. So let's now come to our depreciation. Want to work on depreciation? Yes, we can work on depreciation. What is the depreciation that we have? How many years were we supposed to have this? We were supposed to have the new machine depreciation is 86,000 less 86,000 less the terminal value, which is 5,000. Divide this by 5. Studio. When you divide it by 5, what do you get as depreciation per year? You'll get 16. Depreciation per year. Then, what about the old machine? So we are saying that now we were supposed to have the old machine, which we could have depreciated as well. Sindio? Kama tungekuwa na ile old machine, tunge depreciate. Lakini tuko na new one, which we are depreciating. Depreciation tax shield is the advantage that you're getting. So we are getting advantage because we have this depreciation. We are now foregoing the advantage that we could have gotten were we to depreciate the old machine. Sijui kama tunaelewana. We are depreciating a new machine here, which we are going to take 30% of this amount. That is the advantage that we're going to have. Depreciation tax shield is added. It is like a gain. You add it to this one. Become a benefit because depreciation is normally allowable. It's normally allowable. So that is why we are adding it back. But we are saying that we were having this advantage because of the new machine. And we're going to forego the old machine because alternatively, we should have taken that advantage from the old machine. So now that tumeuza hiyo, hatujapata advantage ya hiyo depreciation in the old machine. So the net advantage that we're going to have is the tax shield between the new and the old. That is the net profit that we need to add here. Sijui kama tunaelewana tena. Tuko na two profits or two advantages. The first one, tungepata kama tuko na new old machine, the old machine. Tungepata hiyo tax shield, which was supposed to be added to whatever profit we were having. Lakini tuliamua kuuza, kwa hivyo tumeforgo. The new one, sasa tunajifanya sasa tuko na tax shield. The real thing is, we have lost on one side, but gained on the other side. So it means that what we are supposed to have here as a result of the exchange is the net advantage, the net profit that we're going to have from the tax shield. So you need to know what was the tax shield in the old one, what is the tax shield in the new one. Because we had sold the old one, we have lost that advantage. We are now getting the net. So we need to know the depreciation on the new one and the old one. So all machine depreciation, what we should have gotten was, what was the depreciation in the old one? Depreciation for the period that we're having. The remaining period was 35 to 50. That was the remaining book value. Were we to still remain with it? Thank you so much. Umeipata. Sasa hii monthly ilikuwa 6250 per year, which is still okay. Alternatively, you can say that ilikuwa imebaki hii divided by 5, which is still the same thing. Haikuwa na net book value, so it is 6250. So the difference between these two is now the net tax shield that you're supposed to have. So our depreciation tax shield is now 30% of 250 minus 6 to 50. So that is 30% of the difference between the two. That is what we should have counted for as a gain. So what is it? Then we add on this 7,000. It is 16, eh? So 16 minus 6250. 16 to 50 minus 6250. 30% of that ni ngapi? It's 16,200, eh? 16,200 not 250 sawa. So this one is 16,200. Thank you. I get 30% of that so that you can see the tax shield that should be added to this profit. So we have that is the 30%. 29. $85. So add that 29.85. Now you add this 7,000 and 29.85. The total inakuja ngapi? What is the total that you're getting? $99.85. So that is the total that you're having annually. That is now the total that you're going to have annually. Going forward, depreciation we have calculated annually, the incomes were annually going forward. Now, that is the cash flow, which is the annual cash flow. What about now the terminal value at the end of 5 years? So we need to calculate terminal values. Determine the terminal value. So the terminal value, the first terminal value that we can still remember is the scrap value of the new machine. The scrap value of the new machine. Scrap value of the new machine was scrap value is equal to 5,000, and then we have the working capital, which is working capital is 8,000. Total we are having 13,000. That is the terminal value. That is the terminal value. So we can get our NPV now in the normal way. So our NPV we are going to have PV for cash flow times PV for how many years? We are having 5 years. 5 years. What percentage? 5 years, what percentage? We are told that the cash flow is 12%. So we have 12% plus PV of the terminal value, which is now 80,000. So we have terminal value times PV. Then we have minus the initial outlay, which we have calculated. So we have to calculate the cash flows we have done. We have the terminal value, which comes once after the 5 years period. Then we have IO. So our NPV is equal to, what is PV for 5 years? Because this is now annual cash flow. This is annual cash flow. So it is PV for. What is PV for 5 years, 12%? 3.6. 3.6. So we have our 9985 times 3.60 48 plus terminal value 5 years or 5 years 12% PV. What is it? PV for 12%, 5 years, 0.5674. So we have 13%, 13,000 or 13 year, 13,000 times 0.5674. 0.5674. All that minus IO. IO we calculated to be 60,125. Studio minus 60,125. Get me what NPV is. Get me what NPV is. So as we calculate that, Florence wants to confirm that if you use the tax shield and the old formula, you still come to the same thing. That is what we want to assist Florence understand. She's not at rest until we confirm that use the old way and the tax shield thing to confirm that it makes sense. Fine, Florence. Let me wrap it from here. So what is the answer? You're getting 16. 754. 16, 754. Point. 0.9, right? These are negative. So you will tell the person, please kindly don't replace the machine. You're going to lose, eh? Yes, let me confirm to you, Florence, that this thing means the same thing. So this is the new method that you are learning today. I hope that one is okay. So Florence, talk about the cash flow. We want to test free cash flow here. Just a small test for your understanding. This depreciation tax shield, and we are saying that it's normally a percentage of the depreciation. So what was the depreciation in the new machine? We are working with the new machine for illustration. The new machine depreciation was how much per year? Tajibu haraka haraka ndio tusonge. Thank you so much. So depreciation was 16. So we are having 30% of 16, 200. What is that, Florence? Get me this. We add here. What is it? 30% of 16. Because we said profit after tax before depreciation plus depreciation tax shield. So add for me the total in Abuja, 48, 60. What do you get as a total? Inakuja ngapi? Inakuja 11, 8, 60, ndio? 11, 8, 60. Thank you. So that would be the cash flow. Stop it there. Let's now come to the old way that you are used to. So in normal way, we would say that from here, less depreciation. So depreciation is how much here? 16. It is 60, 60, 16. It was how much? 16? No, not the new machine, not the old machine. The precision of the old machine to be calculating gap. $16,200. There's something that I want you to test. This one has got a loss. I want you to test with the one that will be having a positive figure. Which example did you do that has got a positive figure? This one is going to have a loss here, because you cannot tax that negative thing. So let's say that you are having a profit, because this one has nothing to do with the revenue. Let's say that you're having a profit here just for illustration, that you're having depreciation with you're having profit before depreciation and tax of, let's say, 50,000. And then we have a depreciation of 10,000. So normally you will have here 40, right? And now you tax it. If you tax 40, I'm using a different example because this one has got a loss before even tax. So this one will be 30% of that. 30% of that will be of 40,000. You'll be having 30% of 40,000 will be 12,000 here. Which you now less, so that you have here 28. Then add back depreciation, which was this one. Add back depreciation. So if you add back depreciation, you're going to have depreciation was 10. So you have 38. 38. That should be our, if you are to have from here, that should be our free cash flow, 38,000. That is a normal way. So let's now do it on the new way that I've just shown you and see if it is coming. So the new way, we are saying that you tax this first, 30,000. The new way is that you tax first this amount. So tax at 30%. So tax of 30% of this will be 15. Right? So that will be giving you 35. Then you have depreciation tax shield. We use 10,000 depreciation, so it is 30% of 10,000. That was the assumed depreciation. 30% of 10,000 is how much? You add 30% of 10,000 is 30% of 10,000 is 3,000 still. So you add that directly, alafu utapata 38. So bado in a letter, if you have information that allows you, you'll still come to the same cash flow. So it is 38. It is still okay. Florence, I just wanted to prove to you that this thing, it will still come through the same thing. That question that was set was not set for this one. That's why I didn't get it. They didn't expect you to use the old one. That is why imekataa. Ukitumia hiyo, profit yenyewe ni 10, depreciation is 16,000, haingekuja hapa. But they knew that you're supposed to use depreciation tax shield. That is why inakuja hivyo. But I just proved to you that when you use depreciation tax shield and the old formula, the cash flow still comes the same way. And that is the most important thing. Okay, I've admitted you.
Thank you so much, Mwalimu. Whatever you're trying to prove, I've also tried to prove myself on this other side. You see, you and Ruth, you decided to take the depreciation for old machine, you subtracted from the new machine, then you took the depreciation tax shield, you added, then you did blah blah blah. So I was trying to follow you very keen. I also did the same using the old formula, and I'm coming at 85. So I don't know where Ruth is coming with 99.85 here with that old one. So with that old one, kindly prove to me that whatever you and Ruth has done gives the same answer. Because I don't know why you're using 16,200, but you told us to use 16,200 minus 6250. I gotten it to be 99.50. Then I subtracted 10,000 from 99.50. I got 50. I took 30% of that 50, which is 15. I subtracted 50 from 15. I got 35. That is after tax. Then I added back depreciation. Yeah, then I got 85.
So, Florence, you're using the old formula, which I told you should have not been applied in this. First, I want us to agree that when you're just looking for the cash flow, the normal cash flow, with the example that I've shown you here, they still arrive at the same answer, which is the free cash flow. Hiyo umeona?
Yes.
Thank you. Come on, may agree, that is okay. Now, that formula, that example that you have just done, the question that you are doing, the precision was coming to be more than the profit. I'm not sure how you use the old formula and you are trying to arrive at the same thing using the old formula. So let's have the precision there. So let's the precision. tell us step by step how you did it. So let's depreciation. Unapata hii. So what did you get here? You're going to have 6,000, which is negative. Because it was not meant for this formula at this point. Though we can arrive at the same answer if you are having the proper question that allows that. This one was meant for that method too. So this one you are here. So proceed. Tell me what you did.
What I did, Nino, the profit before tax and depreciation is 10,000.
Mhm.
I subtracted 16,200. I got a loss. I took 30% of that loss.
That is loss.
I got negative 1860.
30% of that, you get 30% of this. How much is it? Negative?
Negative 1860. Earnings after tax is positive 8060.
So this one
Negative, yes, negative 6,200 minus 1860 gives us positive 8060.
Are you sure?
Yes.
The only thing that will change to positive is this one. When you have negative 6,200 minus 180, 160, this one becomes positive. So it is like 1860 minus 6,200. That is the answer. So tell me the answer here.
Negative 4340. That is where I went wrong. Thank you.
So you know that you went wrong somewhere. Let's proceed to the next question. So the next question, I'm not sure how many minutes left. Still we have time. We can do one more example. Sorry, Milka, you have asked question here and I didn't see, sorry. Let me see what you're asking. Oh, the name not quitting. Is that Milka? I don't think, but fine. So, you're complaining that you're not one of the serious students. So, when did you ask the question? Not quitting. When did you ask the question? Haujanijibu, I'm still stuck here. So CM is same as profit. It is the same as profit immediately. It is the same as difference between sales and variable, not the profit, full profit. Unajua kufanya accounting, we normally have sales, which you can get. Let's say sales is 200,000. The first thing that always less is the variable cost. Is the variable cost, which you can get as maybe 10,000, 100,000. Then you're going to have what is called contribution. It is the difference between the sales and the variable cost only, which is 100,000. And that is what I explained. Then now you have to less fixed cost. Whatever figure that you're given could be even 50. Then you get another one. I don't know, for those who are doing accounts, is this what you call gross profit? To me, I call it contribution margin in financial management. So, Milka, the difference between sales and the variable cost, just before you proceed here, before you come to fixed cost, that is what we call contribution. Now, the margin is the percentage of sales that give you this. Because now it is like sales is divided into two. Sales are divided into two. The first one is the variable cost Another part is the contribution margin. This makes up the total sales. So if you are told that the contribution margin is a percentage, it is normally a percentage of the sales that will give you that value. In this case, we are told the contribution margin, the sales we are told is 25,000. Then contribution margin is 40. So that definitely means that the other option that is still pending is 60%. That means that variable cost is 60% by default. So 60% of this, you'll get it. Now, we are going to have here, 60% of this is going to be in 40%, which is which is going to be 10,000. So this one I think is going to be 15. I don't know. Just confirm. 60% of 25,000 in that. Should be 15,000. So hata ukitumia hii umeamua tu sasa contribution margin umepewa 40, that means that the balance which is 60% is the variable cost. So variable cost is a percentage of 25 and 25,000 which is 15. Calculate hapo utaipata hapo and then you proceed. So sorry, I'm very sorry. I think I replied, how did you get 10,000 Milka? Hiyo niliona na nimereply. Kwa hivyo I'm not trying to demean you or undermine you. I replied that. Hii ingine ni kama kuna vile sikuiona. But hii ya kwanza niliona. Only that the messages are coming so fast and I didn't see that. Otherwise hii ya kwanza nilijibu. I didn't even know, I didn't even remember who is not quitting, so I'm not personalizing anything. I'm sorry for that. Sawa. You wrote profit at 10. No, this one is now what I'm assuming. Nika profit just before fixed. How do you call it? Is it gross profit or whatever it is? Yeah, that is what I meant. Here, the immediate profit just before you remove the cost. Is it called gross profit or something? Yes, but now you know what it is. Sawa, which is now 10,000. Okay, this is what I was referring to. Sawa. Now, if you have fixed cost, you now proceed. After fixed cost, you are now going to have what is called profit before depreciation and tax. But now, because we don't have fixed cost, whatever you are going to have here is going to act as the profit before depreciation and tax. And I'm sure now umefika mahali tulikuwa. Now you decide, you want to start with the tax using the old formula. You start by lessing tax, whatever amount it is, then you lessing depreciation, and then you tax the balance, then you add the back. But if you want to use the new formula that I've just taught you today, you just come and now tax the full amount like this. So you tax this one, tax will be 30%, which is now 3,000. Then you are going to have profit after tax, which is now 7,000. Now on that 7,000, which is a profit after tax, you now add tax shield. Florence, unakumbuka hii tax shield, Tax shield?
Yes, nakumbuka.
Yes, so tax shield is just a percentage of the amount of, it is called depreciation tax shield, sorry. Depreciation tax shield. So una tax direct, alafu unakuja una add to depreciation tax shield na inaingiana. The profit cash flow, the cash flow will be the same. Action and the same. That is it. So I'm very sorry again. I've seen the text. I want us now to look at that question for Deepco. If we have the question, all of us. We have the question, all of us. We can read it. Atufanya haraka haraka vile tumefanya hii, and then we are done with that revision. Now, before I proceed there, I want to make clarification, a disclaimer. Now, let's proceed. So the question says that I am hoping that you're seeing it, that DIPCO Limited is a manufacturing company which makes a wide range of products. One of these products requires the use of a special machine. So they produce a lot of products and they require a special machine. That machine may be just one in the country or two. I don't know how special it is. The current policy is that they need to replace the machine. To replace each machine at the end of its useful life of 4 years. The directors of the companies are considering whether to replace the machine more frequently due to the fact that its productivity declines and running costs increases as it gets older. There is insufficient demand for the company's products manufactured using the machine to justify purchase of a second machine. So there is insufficient demand of the company's product manufactured using the machine to justify. That is why they want to now buy a new machine, because they realize that this special machine is not able to produce the product that attracts the market demand. So they want to buy a new machine. They are justifying why they want to sell the old one and buy a new one. Now, DIPCO Limited sells the products made by the machine at 12 shillings each at which price it is able to sell up to 500 units per annum. That is the quantity. So you can know the sales. The selling price times the quantity, that is the sales you're given there. The variable cost has been given as well. And you're being told that this one is exclude the machine depreciation and running costs. That is the normal variable cost, which is 4. So that tells you that contribution is how much per unit? Contribution in ngapi per unit? Contribution per unit. So we have our selling price. Sales is 12. So if you want the sale price, there's 12 times quantity, which is in this case 500. Still, is it 5,000 or 50? 500,000. Then we could have variable cost, which we are also told that is 4 times the number of units, which is the same. So therefore, our contribution, which acts as the profit, is the difference between this and this, because the quantity is still the same. Quantity bado ni ile tu. So the difference between this and this is the contribution margin per unit. Contribution per unit, actually. Contribution per unit times the number of units, which we know, this one here, gives you the total contribution. We can even decide and start from there. Total contribution minus fixed cost, and we move on. So. Because we know it is a repetition. Kuchukua hiyo na calculate, alafu unapata the difference. The same as getting the difference between these two times, that will be 8. This and this. So it is 8 times 500,000. That gives you contribution. Unakuwa mtu wa hesabu, alafu una save time, ndio? So let's proceed and see what they want to say. That details of productive capacity and running costs of the machines are given as follows. So you are given the units produced, that is the quantity of each year. The running cost is also given. Running cost is now the cost that we're going to use there as the fixed cost. So you will get the contribution and then minus fixed cost. The cost of buying the machine is 6 million. The resale values of the machine are 4 million for year 1. Anyone has a more after year 1, they sell the machine, and that will be as 4 million. If they sell it at year 2, it will be 2.5. If they decide to sell it at year 3, it will be 1 million. Lakini wakiuza at year 4, hawatauza kitu. The scrap value will be 0, so they can't sell anything. So that means that the machine is supposed to live for 4 years, right? That is why in year 4, there is no resale value. The company provides depreciation for its non-current assets using the straight line method. All costs and revenues are paid or received in cash at the end of the year to which they relate, except the initial cost of the machine, which is paid immediately on purchase. The company has an annual cost of 10%. You can read that again. All costs and revenues are paid or received in cash at the end of the year, so that whatever we're going to have as the revenue or cost are going to be the annual at the end of the year. So you're going to have annual cost, annual revenue. So required, advise the directors of DIPCO on whether to replace the machine in year 1 or after every year 2 or after year 3. You remember what we did on replacement analysis, right? And we were talking about the circle, the replacement circle. So we are told to advise the company. So what we need to know, what are the costs, what are the incomes that we have received, and then we see, is it good to replace or not? That is the NPV at the end of the year. So let's start by calculating the income or getting the income or the revenue for each year. We can be able to get revenue statement or income statement for each year. Income statement, so that we know what are the cash flows, cash flow or income statement for each year. So what are we doing? We start with the contribution. Hakuna haja tuende pale kwa revenue. We will be wasting time. So contribution is just the 12, which is the revenue minus the variable cost, which is 4. We have there 8. So that 8 times the quantity. This one is like price minus V times the quantity. So for each year, we can be able now to get, because the quantities are different. So for year 1, 2, 3, and 4. Let's say year 1, 2, 3, and 4. So quantity in year 1, what are you having? Quantity in year 1, you're given there's 500,000. So 500,000 times 8. 500,000. So in year 1, revenue for year 1. Let me write it in a way that you understand. Year 1 is 8, which is this, times the 500. We are going to have 4,000. In year 2, we are going to have 8 times 500, which is still giving you 4,000. In year 3, we are going to have 8 times 400, which is going to give you 3,200. Then year 4 also 3,200, because they are the same. That is your revenue, and the amounts are in thousands, so you should not be worried. I'm not sure if we are together. Thank you. Thank you so much, Boris. So, we have our revenues. Now, so we are saying that after having contribution, we normally do what? Less fixed cost, which is now the running cost or other costs. Fixed costs we are given each year separately. We have 600, 650, 750, and 900. So 600, 650, 750, 900. So here we have 30, 400. Here we have 50. Then we have, what is it? Tell me the figure. We have 3350. Then here, this other one we have 2,300. Thank you. 2,450 and 2,300. So that is where we are. That is where we are. That is the operation cost cash flow or operating operation cash flow. Now that is our cash flow from the operation. We can now have them and now check whether it is good to replace or not. We can now do our NPV. Still, you have the figures. You can now calculate NPV for year one, replacement analysis for year one. So we call it NPV year one replacement. You are saying no calculate D. What does that mean? You D inamaanisha depreciation. They have not mentioned that one represent depreciation. They have not said that the items are supposed to be depreciated on a straight line, or they did, excluding. Why you told that depreciation in a straight line is on a straight line? They normally guide you that the company depreciates on a straight line. Look at the first question, which was very clear. Depreciation is to be provided, is to be. Hii ingine wamesema, how is it supposed to be given? How is it supposed to be given?
Dennis, these are not here. After those years of machine production capacity and running, blah, 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 the cost of buying machine is 6 million. The resale values of the machines are 4 million for year one, 2,500 for year two, and then for year three is 1 million. Then
they say that the company provides depreciation for non-current assets using the straight line method. Thank you. I've just seen it. So we have our running cost. Then now, were you given tax?
Yeah, no, we were not given.
Sorry for that. Did they give us tax?
They did not give us tax.
What do you remember when there is no tax?
Depreciation is relevant.
Huh?
When tax is not given, depreciation is relevant. When tax is given, depreciation is irrelevant.
The opposite. Can somebody help? Ruth, what did you say? Florence is confusing something that will cost her. Somebody to help me. It is irrelevant if there is no tax. So Florence, the reason why we normally depreciate is so that we remain with the balance that can be taxed. Tukisha tax, tunarudisha to your depreciation. We don't have a problem with the depreciation. Tunaitoa and then tunairudisha. That is why we depreciate. When you are not given tax, achana nayo. Because tukisha toa depreciation hapa, what is our aim? What are we meant to achieve? Because we are supposed to add it back kwa sababu hiyo sio pesa ilitoka, there is no cash outflow. Kwa hivyo hiyo pesa iko, it is part of the total amount that we have. Kwa hivyo tukitoa, unatoa, ukimaliza kutoa unarudisha, unafanya kazi ya bure, hiyo ni kazi bure. Sasa, so what we are saying, you understood something but you didn't get it well. We are saying without tax, depreciation is irrelevant, ignore. Thank you. And that is why it has been ignored here. We can now proceed and calculate our NPV. So we are going to do the circle. You remember what we did in circle? Replacement, year one circle. Thank you so much. So Florence is saying that opposite, which is when tax is not given, where there is no tax, depreciation becomes irrelevant. Not really, irrelevant. So we have our NPV, year one, replacement analysis. So year one circle, call it year one replacement circle. So we want to try and tell them, is it good to replace in year one, year two, or year three? So we start with the year one, and we are getting NPV. You know how we get our NPV? We start with the year. Then we have our cash flow. Then we have our NPV, no, PV or PV. Then we have our NPV. So the question is, we are calculating NPV in the normal way. Year one, we have year zero. What was the year zero? The cash outflow. We are told that the cost of machine is 6 million. The cost of machine, which is the initial outlay, is 6 million. There was no installation. If we had installation, we add, but we don't have. Tungeongeza hapa. So PV is 1. Here is just 6,000, but now you put it in bracket because it is money going out. Then year one. What happens in year one? We want to ask ourselves, can we just have the machine after year one? We replace it. So in year one, what did we get after year one? In the other example that we did, in year one, we are still having cash outflow. Yani bado pesa ilikuwa inatoka in year one and even in year two. I think that is what we did. Lakini sasa hii, this time around Belka, in year one, there is money coming in. We have seen cash inflow. Sasa, so mwaka ya kwanza, tumepata pesa. Alafu after kupata hiyo pesa, at the end of the year, we decided to replace the machine and we are going to sell it. There is resale cost. So our operation called cash flow for year one, we are given as 3,400. Is it true? The inflow, the cash flow in year one is 3,400. What is PV? What was the percent that was given? It was given 10% for year one. So 10%. PV ni ngapi? Tufanya haraka haraka, there are only 3 and then we go. There are only 3 and then we go. Nilikuwa na expect watu wakose hii class. Mbona mjalala? I only wanted like 2 or 3 people. 09, 091. Kwa nafikiria mtalala, usingizi ni mingi, lakini mmefika, mmefanya vizuri. I'm gonna expect watu walale. Aya, sawa. Give me now, how much is the NPV for this one? Calculating. Then, now in the same year one, we decided to sell the machine. So we are selling the machine. Year one, if we decide to sell the machine, Mary, what we are saying here for year one circle inamaanisha we want to replace the machine after year one. Yani tunanunua at 6,000, tunatumia at the end of year one, tunapata pesa yetu. Tumeambiwa vizuri that these revenues, expenses are always, all costs and revenues are paid or received in cash at the end of the year. So hata hii tulipata at the end of year one. Now hiyo time tunauza hiyo machine. So we generated the revenue and then the same year one we are selling it. We are getting another money from the sale. So in year one, circle, we are going to have in the same year one, we are going to sell the machine this time at 4,000. We are going to use the same. So what are we having here? Hii inakuwa tamu sana. Ukiona kwa mtihani hiyo ndio unaanza nayo. 30, 90, 91. Are you sure that is the figure? 30, 90, 91. Fine. You're giving me the present value. Alternatively, you can even add this and this. Una add in na hii inakuwa 7, alafu una multiply once. It's you to decide to do them separately or just add this and this. Which one is okay? Get me the PV. Okay. So it was 36. Present value for year one. So you are saying that the present value for year one is 30 and 90.94. And then you give me 36. So what are you having after year one? What are you going to have as your NPV? 727.34. Keep this one dearly in your hearts. The reason is, I want you to understand something. When you want to compare and advise whether to sell at year 1, year 2, year 3, we don't want to be biased. We don't want to be biased because this machine is going to generate revenue at different periods. So we're going to compare different periods because sasa tumeona year 1, we are going to see year 2, year 3, and year 4. Those years allows the machine to generate some revenues. So it will be unfair to compare a situation where it only generated revenue for 1 year. We compare it with the situation where it generates revenue for year 2, unless we use a different method or formula. Kwa hivyo, just keep this one dearly in your heart as we proceed to year 2. So let's come to year 2. So this one was sale. So I'm just removing the sale. So in year 2, we decided to generate our income for year 2. That is now year 2. Where andika hii NPV year 2 replacement cycle. So we're going to generate another revenue for year 2. Year 2, the revenue is 3550. That is what we got here. 3550. What is now the new discounting factor for year 2? Discounting factor for year 2. Discounting factor for year 2. Yes, it is 3350. So 3350. So give me the discounting factor.
0.8264. 8264.
Thank you. The amount, present value.
Dennis, I have a question.
Mm-hmm.
Resale values, it is an income. Resale value, is it an income?
Resale value. It can be a loss. Present value is just an equivalent of that future value in its current state. Like umeambiwa utapewa 1,000 after 2 years. Lakini saa hii, what is it equivalent to? So it can be a loss. You're going to lose 1,000 after 2 years. So what are you going to lose? What is its equivalent today? So that is why we are saying the time value of money. 3,400 after the end of 1 year is equivalent to 3,090 today. Sasa hii pia, it can either be a loss or a profit, because if you are having a loss here, you will still multiply with this and get a loss of its equivalent today.
But you see, Dennis, the way we calculated the NPV, I think, see, the cash flow was 3,400 times discounting factor, giving us 3090.94. Then yes, for year 1. Then the resale value was 4 million times discounting factor, giving us 3636. I was thinking that this 3636, we add it. Or see, it should be 3090 minus plus, no, negative 3090 plus 3636 minus IO.
It was not negative. It was money that is coming in. The 3090 was the revenue that we received in year 1. And then the same year 1, we sold the machine and we got another amount, which is now 36 something. So you add the 2, then minus this. The amount of my 700. The only expense that we incurred in that year was this. So
and then this year 2.
Huh?
Year 2 same, I add.
So get me the value for year 2 first. Year NPV for year 2. And then the present value for year 2.
But ujaweka the resale value, sini 4 million. 2,500. 2,500.
Sijafika huko, nipe.
Hiyo ni 2768.44.
27?
68.44.
Sasa mimi nilikuwa nataka hili, umekataa kunipea. So the same year 2, tumeuza hiyo machine. We are told that in year 2, if you were to sell the machine, the resale value will be 2,500, isn't it? So we are going to sell it at 2,500. So we are using the same PV for year 2. So it is now this one. So get me the value.
2066.
2066.00. I add for me these ones. Then minus that. Just add these ones minus this. That will be the NPV. The first one was 1925.58. 1925.58. Thank you so much. Again, we keep this one. That is the NPV for year 2. So we cannot say that they should sell it at year 2 kwa sababu the NPV is more than year 1. That one will be biased kwa sababu this NPV has been stated by the additional cash flow. It has been stated by the additional cash flow. So it will not be fair to judge that year 1 haikufanya vizuri, year 2 iko sawa. No. Just call it there. We shall proceed to year 3 first. So year 3, we did sell in year 2. So therefore, the revenue for year 2, just let it remain. But now wait for year 3. So year 3, got another revenue, which was how much? And that's how you do a replacement analysis. Do the same thing. Sasa proceed to year 3. Year 3, sasa kuna how much? What was the revenue for year 3? Year 3, the revenue was 2450. Confirm. So in this 2450, we can also sell at year 3 at 1,000 now, I believe. 1,000. What is the discounting factor for year 3?
0.75, 13.
75, 13. Use the same here, 75, 13. Then now multiply this 2 and then this 2. I can do for you the last one here. This one will be 7,000. That last one is going to be 7,000. Let me calculate. And then for me, get me the total. What is the NPV for year 3?
2451.365.
Added all of them. 24?
You've asked for NPV after 2451.365. 2451.365.
Okay. So that is where we are. Can somebody do for year 4? 1 minute. Proceed with year 4. The same way. That. So for year 4, you go up to year 3, then you add year 4 now. So from here you add year 4. The revenue for year 4, you assume that you got revenue up to year 4, which was how much? Revenue for year 4 was 2,300, right? And then give me the starting factor here. We didn't have a resale value here, so we didn't sell anything. So just add this only. What are you getting? Discounting factor for year 4. We are almost done. I also need to go back to my QB column.
0.6830.
0.6830. I get you the figure here. Is it around 18? Is it 11 or 12? What is it? 300 times 0.6830 or 15. So the total inakuja ngapi?
NPV is 3270.
Thank you so much. Now, because of the different period, whenever you're taught to advise a client where you have seen that the cash flow are of different periods, what do? We did that example with November 2019. What did we do when the cash flows are not the same period? Professor, what did we do? That is the last part, and then we go.
We take the year that has the highest NPV when it is positive, but when it is negative, we take the year that has the least negative value.
That is Florence. Another person?
No, sorry. First, for us to calculate the sorry, we'll have to get the annual equivalent value. And annual equivalent value is NPV for each year over PV per 10% each year.
Okay, so what is the formula for annuity equivalent? We calculate the annuity equivalent. What is the formula? Another person to tell us? NPV of each year all over PV farm. Thank you. That is exactly what you need to do. So now for you to advise, you come to getting the annuity equivalent value. So calculate the annuity equivalent borrowing, which are for year one. We have the NPV, which was 727. Give me the figure, just say 727 point. PV for year one is so we can say that it is NPV or lower PV. PV for year one is just the same, 0.9091. NPV was 727 point. Then we come to year two. Now, whatever you're going to get there is what you can use to judge. We are going to have, guys, speak and get me the figures. Just say, haraka tuendelee. Soma what you're seeing. What was the NPV for year two? Na hata hii year one ilikuwa nini? Niambie tu. Talk. Lea. Usiogope, ongea tu. Ndio tuende tulale. 1925.38. So we have here 1925.38. Get me PV for year two. PV for year two will be
Dennis, annual equalization for year one, it's 800.06.
Kwanza nilikuwa nataka kuna some decimal here.
It is 727.34.
And then it is now
800.066.
People.
Yes.
Okay. Thank you. Now get me the PV for year two. PV for year two, 10%. What is it?
Hiyo PV ni 1.7355. 1.7355, giving us 1109.41. 410.
We're almost there. So those who are giving up, please don't give up. Don't sleep. Na with hesabu mtu hawezi lala. Fanya hesabu utalala aje. Oh, sorry. Melka, sorry, Melka. We are doing PVFA. So PVFA, the formula is different from PV. So use 1 minus bracket 1 plus R negative N, then all of these over R. I hope that is the formula. So you don't use the one for PVFA. So you use use PVFA for year one, year two. So here N you put 2, red ni ile 10%. Sawa. So utapata hii figure. Ukiweka hiyo 0.8 something itakuwa PV. So I'm explaining na quit ama kwa wapi. Let's proceed. Na wale wako. Let's proceed. So get me for year 3. What was the NPV for year 3? Just get me the NPV. NPV for year 3. Where? Kama umenipea zote sasa, nilikuwa nataka NPV. Somebody will be following na hata kwa ameona. Help me with NPV.
NPV for year 3 is 2451.365.
Right?
365.
Olowa. PV ilikuwa 2.4869, ndio? So you're getting here 98.5.7. Let's do the last one. Year 3. Circle. Well, we're having 31. No, 30. It was 32.71. All over 3.1699. You're going to get there. So what are you getting here? One or 1.89. So now you rank them. The one that has got the highest annuity equivalent value, that is the one that you prefer or advise to be taken. Which one is that? Year 2. So you complete and say that the optimal, right, and say that the optimal replacement cycle is year 2. The optimal replacement cycle is year 2. Florence, we've just done the same thing. I wish Milka was around as well. So you conclude and say that the optimal replacement cycle is year 2. Therefore, the company should replace the asset after every 2 years. The company should replace the asset after every 2 years. It is the cycle that has got, it is the cycle that has got the highest annuity equivalent. The company should replace the asset after every 2 years. It is the cycle that has got the highest annuity equivalent. Thank you so much. So those who tried or attempted the question, you can now check where you went wrong. Wakati ulikuwa unajaribu hiyo swali, unaweza angalia sasa ni wapi uliteleza, si ndio? So you can check. Florence, I know you tried it, and Topista also tried it. Winnie also
Yes.
tried it. Check. Thank you so much.
No,
Yeah.
Dennis,
Sorry. Any question?
yes, I have a question. I'm asking, whenever you've been given depreciation and there is no tax that is provided, the 30%, there's no need for you to calculate depreciation. It is a waste of time.
Exactly.
Aya.
Let's meet another time. Use depreciation, add tax. Okay. Sawa. Sorry for that. Next time sasa uko sawa. Sawa.
Mwalimu, kesho record. Kesho is a tough day. Kesho record hiyo nini revision.
It's fine. Tunaweza meet kesho saa 2 usiku, haina shida. I'll also
Sawa,
have
asante.
enough time to go out.
Okay.